In this chapter, we're going to talk about the valuation of bonds. So some of this should be review, so we'll pass through some of this fairly quickly. And then eventually we'll get to some quantitative questions discussing how you find the value of a bond. So before we even get started, let's think about the term value. Value means what would you be willing to pay to purchase the bond? It's an individual question. Each of us could have different answers because we all have different tastes, especially with respect to risk. So let's think about some terminology first. We have a bond certificate. Basically, it's a contract of sorts. It states what the terms of the bond are. This particular debt, just like most debt, has a maturity date. There's a final date of repayment. The time or the term is the time that's remaining until that repayment date. And just like every debt, there are some interest payments. We refer to them with respect to bonds, we refer to them as coupons. So when you purchase a bond, it's a little bit different than other forms of debt, like a mortgage or a car loan. When you make a mortgage payment, all the payments are the same. They're monthly payments, and the interest and principal are incorporated into each type of each payment. With a bond, government bonds and corporate bonds, it's a little bit different. These are essentially what are referred to as non-amortizing bonds. That is, they don't dwindle to zero when the bond is paid off. It's an interest-only payment. So when you buy a bond, a corporate bond, you're going to receive a certain amount of coupon. It's only going to be paid typically twice a year. So every 6 months, you'll get a payment of a coupon. And then when the bond matures, you'll get the principal of the bond, which is always $1,000. There are some returns that we'll talk about. And the two that are the most common is the yield to maturity. And this essentially tells us the return you would earn if you purchase the bond at current price and you hold it to maturity. The current yield is the return if you purchase it today and you earn the coupon in the next year. So the current yield is kind of like the current return or the annual return for the most recent year. Zero coupon bonds don't make coupon payments. They always sell at a discount. So what discount means is that the price is always lower than the face value. So these are typically what's referred to as pure discount bonds. Treasury bills are United States government zero coupon bonds with the maturity of up to 1 year. So let's think about the valuation process. There is a worksheet that I provide for you, which is called Bond Valuation Worksheet. And as you see the worksheet, there are several variables that we need to know. What's the par value? Well, unless you're told differently, it's always $1,000. In this case, it's a zero coupon bond. So you put a zero in for coupon. We don't need to know the required return. We're going to calculate the yield to maturity. And it is a semi-annual paying coupon or a maturity. The time to maturity here is 2 years. And it pays or has a compounding frequency of once a year. Now, in the newspaper, when you see how a bond is priced or how the price is quoted in a newspaper, it's typically quoted as a percentage of par. So 95.35% means that the price of this bond is 95.35% of $1,000 or $953.50. So the yield to maturity on this particular bond is 2.41%. Right? So again, let's kind of review this a little bit. Corporate and government bonds are quoted as percentages of par. Now, what I will tell you, though, is municipal bonds are quoted slightly differently. Municipal bonds are quoted in terms like 96 and then a colon 16, which means it's 96 and 16/32 of a percent. So that's, in this case, 96.5%. Or $965. So again, we just need to know a little bit about how bonds are quoted, and now we can calculate. If you know the price, you know the coupon, we can always solve for the yield to maturity. So this yield to maturity essentially is the single discount rate that's going to tell us what you will earn if you pay the current price and you receive the future values of these coupons, and of course the maturity value later on. So essentially we're solving for this y in this calculation. And you can see that's a fairly involved mathematical calculation, but we can solve for it, and certainly Excel does this for us quite simply, actually. So if you think about the basic principle of valuation, right, we need to find out what you would be willing to pay for a bond. So the value of financial securities, according to the law of one price, the value of financial securities, or the price of a financial security, has to be equal to the present value of the expected future cash flows. So we need to find the present value of the coupon payments and the present value of that par value somewhere out in the future. Now, what we will find mathematically is that interest rates are inversely related to the value. So if interest rates are rising, bond values are falling. So again, let's just kind of review. The yield to maturity is the single discount rate that equates the present value of the bond's remaining cash flows to its current price. Again, that's the rate of return you earn if you buy the bond today and hold it to maturity. Now, the yield to maturity on a bond selling at par will always be equal to coupon. So if the yield to maturity was 10% and it was a 10% coupon, you would know immediately that that bond would sell for roughly $1,000. But what happens as interest rates in the economy change? As interest rates change, the yields that people want to receive are going to be different. They change with interest rates in the economy. However, the coupon doesn't change, it's fixed. So we will see as interest rates in the economy change, that must mean that the price changes. And we will see how that works as we explore the pricing mechanism a little bit further. As a general rule, if the value of an asset is greater than or equal to its current market price, then you would want to buy it. This is essentially saying that the benefit is greater than or equal to cost. You would want to purchase the asset. As well, if the expected return of an investment, if it's greater than or equal to what you require, you would buy it. This expected return in the terms of bonds is also equivalent to talking about the internal rate of return in the capital budgeting sense. But for a bond, we would refer to the expected return as the yield to maturity. Now, the required return is something we have to talk about a little bit further on in this video. But the required return contains inflation and it contains risk. So as the economy changes, the required return changes. If the required return is going to change, then we know that values and prices are going to change. So here we have a bond. It's a $1,000 par value, as a 5% coupon. In the economy, this type of bond currently has a required return of 8%. It has 10 years of life, and you can currently buy this bond for $825. So what information can we get from this particular bond and this information? The first thing we see is that the bond, the current yield is 6.06%. So if you spend $825 for this bond and you receive $50 over the next year, 5% of 1,000, then you will earn 6.06% in year one. The value of this bond is $798. So would you pay $798 to get something that was selling for $825? Let me say that another way. Would you spend $825 to get something worth $798? And of course, in this instance, you know that would be a bad decision. The yield to maturity is the other number that we've talked about so far. And in this case, if you buy this bond at $825, you would earn 7.56%. The challenge here is that you want to get 8%. So this is an example of a bond that you would not want to buy. You're not receiving a high enough return, or the price is too high for the purchase of this particular asset. In this particular case, we have this zero coupon bond at 8% for 10 years. The current price is $450. As you can see here, what's the current yield? Well, there's no interest, there's no coupon, so there's no current yield. You don't earn anything until this bond matures in 10 years. The yield to maturity on this bond at $450 is 8.3%, and again, we wanted 8%. So this bond is an attractive bond. You're going to earn more than what the bond is actually selling for or selling at. In addition, the value is $463. Would you pay $450 to buy a bond that was worth $463? And of course, the answer to that is yes, you would. So this is an example of a bond that is worth purchasing. We've been talking about some behavior of bond prices. So we can talk about bonds that sell at par. The par value is the principal, or $1,000. So if a bond is selling at a par, the price equals its face, or again, $1,000. We mentioned the word discount earlier. A bond that's selling at a discount is selling if the price is less than its face value. That means the price is less than $1,000. A premium bond is selling at a price that's greater than its face value. So, I mean, what is the importance of these terms? Well, in reality, there's no importance. This doesn't talk about bonds that are good or bad bonds. It just talks about a relative position of price to the face value of a bond. So let's think about how we might make some sense of these relationships. If a bond is selling at par, the coupon is exactly equal to the yield to maturity. I think a way to think about this is the coupon is what the company wants to pay you. The yield to maturity is what you want to receive. And the company also wants to borrow $1,000. So if they're willing to give you exactly what you want to receive, you're willing to give them $1,000. But what happens if they're willing to pay you more than what you really want, right? if the coupon, what they're willing to pay you, is more than the yield to maturity, the return that you want, then you're willing to pay extra for that. So in this case, if the coupon's greater than the yield to maturity, then the price of the bond will be greater than $1,000. And of course, the opposite is true if the coupon is less than what you want to receive, the yield to maturity. In that case, it would be selling at a discount. So let's look at this particular bond. Procter & Gamble issued a bond, has 7 years remaining. It's $1,000 face, a 4% coupon, and it's making annual coupon payments. If the current market interest rate is 3%, what is the bond's premium or discount? And then what if the current market rate were 6%? So let's see how this might work. If you go to the bond valuation worksheet, we can look at these two let's kind of go back, sorry. We need to find out whether or not this bond is selling at a premium or a discount. So if the current market interest rate's 3% and it pays a coupon of 4%, it's paying you more than what you want to receive. So at 4%, it would sell at a premium. If the current market rate was 6%, then it would be paying you a coupon less than what you wanted to receive, so it would sell for a discount. Disney issues a 15-year 6% coupon. If the market interest rate for Disney debt is 4.5%, we want to calculate what is the discount or premium. And then if the market interest rate was 7.2%, then what is the discount or the premium? So I'm going to expand this a little bit so you can see a little better here in the video. A 6% coupon, if the market interest rate's 4.5%, then this bond is selling for $11.61. That's $161.09 more than its face value, so it's obviously selling at a premium. However, if the market rate increases to 7.2%, the value is going to drop to $892.07, which then is obviously it's selling at a discount, which is roughly $107.93 is the discount below $1,000. So what can we say about time and bond prices? Holding all other things constant, if nothing changes in the world, a bond's yield to maturity will not change over time. Holding all other things constant, right, the price of a discount or a premium bond will naturally move towards the par value over time. We'll look at this mathematically, but let's think about this. When a bond matures, how much do they owe you? They owe you the principal of the bond, which is $1,000. So the day the bond matures, that piece of paper is worth what they have to pay you, which is $1,000. So if a bond's yield to maturity hasn't changed, then again, the internal rate of return on the investment equals the yield to maturity, even if you sell the bond early. So again, the return on the investment, right, doesn't change as long as nothing else changes. And we know that in the world that we live in, that really doesn't happen, right? Things do change. So let's look at these 3 bonds here. These bonds all have the same maturity of 10 years, and they all have the same required return of 10%. If the coupon is 12, again, it's 12 is greater than 10, so we know this is going to sell at a premium, so this bond would actually sell for $1122.89. Now, I suggest you try this out in the bond valuation worksheet to make sure you get the right answer. In addition, if the coupon of this bond was 8%, it would sell at a discount. The coupon is less than the required return, so again, it's going to sell for a lower price. So, what does this mean, or what's the purpose of this discussion, if you will? Well, let's look at what happens to a bond, right? The second bond, the third bond we talked about there, was selling for $8.77. If you bought it today for $8.77, what I suggest you do is go back to the bond valuation spreadsheet, input the data for this bond, and put in there a price of $8.77. When you do that, you're going to find out that the yield to maturity is equal to 10%. Okay? So the yield to maturity of this bond, the return you get if you buy today and hold to maturity, is 10%. Now if you go back to the first bond, change the coupon from 8 to 12, the price will be that $1,122. Type in $1,122 as this new price, and what you'll find is that this bond is selling with a yield to maturity of 10%. Both of these bonds are selling at a yield of 10%. So if you required 10%, both of these bonds would be equally attractive. Why is it, or how does that make any sense? Well, the reason is because the premium bonds are paying more cash than the discount bonds. And remember, the coupon is greater than the yield that you really want, right? So since you're getting more, you're willing to pay more for those bonds. People invest in bonds for the cash flow, not for the capital gains, right? So that's a different way of thinking about investing than the way we normally think about when we think about investing in stocks. So that's the first part one of the valuation of bonds video.